Today, I'm authorizing the release of 1 million barrels per day for the next 6 months.
According to our intelligence, Russian units are not withdrawing, but repositioning.
In order to purchase Russian natural gas, buyers must open ruble accounts in Russian banks.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Biden's record oil release. The U.S. president's plan to tap strategic reserves risks undermining his green credentials while crude prices continue lower. Putin's gas ultimatum. The Russian president demands buyers to pay for fuel in rubles or else European gas prices fluctuate. And stay with Bloomberg TV. Today we'll be speaking to a top lineup of guests. Well, from the Ambrosetti Forum, we'll be talking to the Dutch Central Bank Governor Klaas Knot and the EU Commissioner for Financial Markets, Mered McGuinness. Send in your questions on IB Plus TV Go. So good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. This Friday, coming to you from the lakes of course, Como. I'm Francine Lacqua in Cernobbio, Italy, where we focus on the world economy under this conference. Also, Isabel Schnabel, ECB board member, shows up tomorrow to talk about inflation. We have an exclusive conversation on inflation, on possible ECB tightening with a central bank governor. Now, first, though, let's check in on the markets. Our Danny Berger's in London with the very latest. And Danny, we're also getting some breaking news for manufacturing PMI.
That's right. March manufacturing PMI coming in at 56.5. The preliminary was 57, so a little bit weaker there. Reflects also we saw in China a lot of the PMIs missing as well. Concern about the economy. Still strong, but Francine, it's a more positive market to start this first quarter. Oil is declining. WTI below $100 a barrel, down 1% after falling some 7% yesterday. Of course, Biden announcing SBR releases. That giving some solace to the equity market today. Yesterday it didn't. We saw a decline of more than 1.5% for U.S. equities. But today, futures market up 0.4%. Now, yesterday also saw the close of the 210s inverted. Now, we are having this conversation of just very brief inversions. When does that last to a more sustained inversion? Well, for now, that fear ebbing as we are just 2 basis points as all yields are moving higher this morning, and the yen also declining for another day. Here's your view in Europe. This is also positive as well. We're looking at gains of 0.2% across most of these regional benchmarks. Even the UK doing well, Francine, despite many of the oil majors living here, up about 0.4%. So as we look at a rebound, is it a bear market trap, Francine, or has the bottom been put in, and is it now safe to buy?
Yeah, the $1 trillion question. Danny Berger, thank you so much. Now, President Biden has been defending his energy plan. He says the plan to release 1 million barrels of oil a day from U.S. reserves over 6 months lays a real foundation for the country to actually achieve independence.
Today, I'm authorizing the release of 1 million barrels per day for the next 6 months, over 180 million barrels for the from the Strategic Petroleum Reserve. This is a wartime bridge to increase oil supply until production ramps up later this year.
Well, here to talk about the latest market moves, Bloomberg's markets editor, Christine Aquino. We'll get to Jeff Yu, of course, from BNY Mellon in just a second. Christine, I have a million questions, first of all, on what the markets are looking at. We spoke to Mohamed El-Erian earlier, and he was saying, look, the problem with the stock market is that it's one of relative value. If bonds don't give you any return, then even if you think that the war is being mispriced, you have to put your money in stocks.
Absolutely, Francine. And I think that's why we've seen a little bit of TINA action in equity markets this week. That's there, of course, there is no alternative, because that is, again, kind of the adage that investors are working off of at the moment. The traditional 60-40 portfolio definitely getting challenged by the bond route, which we know is quite the historic decline in last quarter. And in some, by some measure, it is the biggest decline on record. And so if you're an investor who really can't go to bonds because of those losses, then where else would you want to go, And stocks seem to be the answer at the moment. But again, a lot of uncertainty potentially still not being priced into this market that investors really have to be wary of over the next couple of weeks and months.
So, Jeff, where do you want to be invested in the markets? Are you fully invested in stocks?
I would say it's a combination right now of having diversification. That's still necessary. What we're seeing in our underlying flow monitors, people want stagflation protection, and that means two particular places, actually. Areas where, one, you have high real rates or hiking central banks, Latin America, and secondly, commodity-linked currencies, Aussie, NOK, and even sterling, actually, we're seeing clients buy it because of high mining and energy exposure with the FTSE.
Yeah, it's interesting that you actually pinpoint to a lot of currency moves, because, Christine, this is something that we also spoke to the OECD. You have to forgive me, it's very windy. It's beautiful, but it's very windy in Italy at the moment. So we were speaking to the OECD chief economist, and she was saying, look, one of the things that central banks need to watch out for is, of course, this currency volatility, because it could complicate what they're trying to achieve even more.
Absolutely, Francine. And I know that we've seen a number of central banks already getting a bit more concerned about their currency levels. The Bank of Japan, of course, looking to potentially curb some of the moves in the Japanese yen. We also saw, for instance, the Norges Bank yesterday kind of making a move on their currency as well, because, again, it's kind of, I guess, a different sort of currency war where, while they might not necessarily want excessive strength in their currencies, which is kind of what we're seeing now. And so it's going to be quite an interesting space as well, especially when you factor in the dollar effect and, what the Fed tightening path means, what the potential disruption to commodity flows means. That will have big implications for the dollar and the rest of the G10 and emerging market FX complex.
Yeah, it certainly will. Jeff, what do you worry about the most in the markets? I know, for example, Mohamed El-Erian was pointing to some of the commodity countries that don't have that much solidifying, I guess, stability when it comes to finances. Are we going to see something very ugly in certain types of emerging markets? Or how do you see this playing out?
Well, right now, not really. It's one of the phenomenons seen since the pandemic. Because of some of the supply chain issues and higher prices, there's actually been quite a bit of a demand destruction. So, traditionally, the current account deficit countries, especially in EM, where you worry about balance of payments crises, they've actually seen surpluses emerge. But I wouldn't call that healthy, because domestic demand has been suppressed so much, and you can only go so far with this. I don't worry about financial risk. One tail risk we actually have been looking at is, and the UN World Food Programme, they've been worried about this as well. Ags, so famine, for example, rising in agricultural prices. The war has not helped the situation, and I think this is going to start to move up the agenda as well.
Yeah, and this will, Jeff, actually hit Europe the most because of fiscal spending, as I guess we try and help with the refugee crisis coming from Ukraine and elsewhere, but also impacts the Middle East huge because of their dependence, of course, on some of the flour, wheat and grain coming from Ukraine and Russia.
So for the Middle East, that certainly is an issue. Many parts of Africa, that's been highlighted as well. Going back to Europe, the fiscal impulse we are seeing in Europe, that's actually, I think, generating inflows. Again, looking at our custodial flow data, seeing inflows into European equity markets in particular. I think valuations have been attractive for some time. But people are seeing this could be the final, fiscal injection on top of NGU, the other programs that we've been waiting for Europe to get reflation happening. So now bets are being put forward for the ECB to move, perhaps on policy guidance even before the June meeting. So one hike this year, two hikes this year, everything's on the table.
Jeff, thank you so much. As always, Jeff Yu there of Senior EMEA Market Strategist at BNY Mellon, and our Markets Editor, Christine Aquino. Now, we'll have plenty more, of course, on the markets. We'll talk about U.S. jobs. It's today. Also, the European Banking Authority publishes its Ukraine war risk assessment. So we'll be joined by the EBA Chairman, Jose Manuel Campa, to discuss the stability of the EU's banking system. That's coming up shortly, and this is Bloomberg.
In order to purchase Russian natural gas, buyers must open ruble accounts in Russian banks. When assets in dollars and euros are frozen, it makes no sense to use these currencies of these countries.
Now, Now, the Russian President Vladimir Putin on why it makes no sense to make him or to him not to demand rubles for Russian gas. Of course, it makes sense to him, but it doesn't make sense to the people that have to do that given the sanctions and the complexities over it. Now, in spite of European leaders rejecting his demands for rubles, Vladimir Putin says Russia aims to keep supplying gas to European customers. His statement eased some concerns amongst buyers. Now, European gas futures had actually jumped earlier this week, but have since pared back some of those gains. So for more, we're joined on this by our European correspondent Maria Tadeo, who's in Budapest. Maria, to put it very simple, I know leaders hide behind the fact that there are treaties and not treaties, and of course they've signed contracts, but there's a generic idea that actually leaders don't want to make Putin's life easier, given the sanctions and that, you know, they're trying to make him back away from the war in Ukraine.
Yes, Francine, and you nailed it. That is the big problem for European countries here. They say, one, they don't want to play into blackmail, but two, if you pay in rubles, essentially you're going against your own sanctions. You put your companies in a position that they will also go against the sanctions that the European Union has approved, and therefore you are essentially shooting yourself by doing this. It's a big problem the governments will tell you they have. At this point, they don't want to do it out of principle, but also it would destroy the whole message we've heard over the past 4 weeks that Russia will have to pay a very heavy price for invading Ukraine. Now, for the time being, however, we did hear from the Russians saying we want to get it in rubles, but it doesn't mean we're going to cut the flows. And the Germans repeating the countries are in euros. That's the way it's going to be. We're not changing. But having said that, Francine, behind the scenes, European officials are starting to work on contingency plans, on a plan B in case the flows get cut off. That is something that they're prepping for.
Maria, thanks so much. I'm Maria Tadeo there in Budapest looking at the energy side of things. We also need to look at the bank side of things. Now, the European Banking Authority does not see Russia's invasion of Ukraine as an immediate threat to the stability of the EU banking system. The regulators concerned about the vulnerabilities created from the long-term fallout of the war. Now, sanctions, supply chain disruptions, cyber risks could all disrupt the European economy. Well, we are absolutely delighted to be joined by the EBA's chairman. He's Jose Manuel Campa. Mr. Campa, thank you for joining us for a very important conversation. Now, you basically, cite some heightened market volatility for banks. Is this a good thing because they can actually take advantage of it, or is it the bad kind of volatility that banks could really struggle with?
Well, good morning. Thank you for having me. First of all, as you said, volatility sometimes can be good for institutions because at the end, with volatility, particularly those involved in trading and market-making activities, they can actually benefit from the movements of markets. But the volatility at this stage that we're more concerned about is the signaling, obviously, enhanced uncertainty on the macro environment given the geopolitical situation. And that uncertainty, depending how it develops over time, it might become higher risk, and that's a concern for the European banks.
So, Chairman Campa, what parts in the financial system are you worried about? I know there's a lot of talk, there's a lot of, calls or chatter about margin calls, for example, having to be put on some of the commodity traders. Is this where the fault line is?
Well, it's certainly this part where the risks are not. Direct exposures to Russia by the European banks is small. So in that sense, our concern there is very limited. We estimate there's only 0.3% of total assets that are direct exposures to Russian counterparties. So that's not really a concern. As you mentioned, now in the short term, of course, excess volatility and some of the margin calls that are being derived from that in commodity markets, both in some of the basic commodities, also in food prices and food commodities, it's an area of concern. We have seen margins increasing. So far, I think that the margin calls have been able to be met very properly. But of course, it's not just for banks to do margin calls. It's also non-financial corporates that are involved in some of these markets, and they may be challenges with liquidities, and that's an indirect effect that we're carefully watching.
But, Mr. Campa, when you say challenges with liquidity, to a point where something systemic could happen, or have banks been, pretty careful with these kinds of lending?
No, clearly not. At this stage, we don't think there's any systemic concerns arising from this. We think markets are working properly, margin calls are being attended by those that are being requested to increase their collaterals, and I think that both banks and non-financial corporates that participate in these markets have sufficient liquidity to be able to accept those calls. So I don't see any area for systemic risk, but nevertheless, we need to remain watchful.
Mr. Campa, you're talking about inflation. Will it lead to banks having losses because households may not be able to repay some of the loans or some of the mortgages? Or, at the margins, can they also benefit from inflation if interest rates rise?
You're absolutely right. Inflation has two sides for banks. If inflation materializes in higher interest rates, and then maybe the likelihood that higher interest rates will rise both from the monetary part but also on the markets, that's good for net interest income of banks. But of course, the overall, it's not just inflation, but the overall macro environment. The macro environment deteriorates, and that results in a difficulty for borrowers on making good on their payments and increases in non-performing loans on banks. That's negative news. That's why we say in our risk assessment that although the direct effects that we see from the crisis are small and manageable, we remain concerns about second-round effects and more macro uncertainty that may end up in a deteriorating macroeconomic outlook that then will affect banks' profitability as well.
Right. So you're not expecting some kind of, big loan losses. And if you were, are there banks, where are the banks most vulnerable? I know the Italian banks have quite a lot of exposure, for example, to Russian commodities. Some of the German banks have also been highlighted.
Yes, if I may highlight, the starting position of the banks is very solid at this stage, both on capital ratios and liquidity ratios. Also, we were already expecting an increase on non-performing loans as the last leg of coming out of the COVID crisis. As we saw some of the measures, particularly the government guarantees and moratoria expiring, we were expecting some non-performing loans to increase, which up until now have not materialized. So on top of that, now we need to add concerns about the new macroeconomic situation and the geopolitical concerns. So as you say, I would say that both those banks that have been more affected by COVID impacts in the countries where COVID was more hit, plus now those that are more affected by Russia, the ones that are more likely to be hit. It depends on business models, but geographies, as you say, southern countries in general more affected by COVID. Also, some of the countries more closer to trade relationships with Eastern Europe more affected. Those are the ones that are more likely to have the biggest hit.
Mr. Campa, when you look at how a lot of the banks are dealing with Russia, are they going further, maybe even too much further, against, not against the sanctions, but so they're trying to deal with sanctioned individuals, where they're taking it a step further and maybe sanctioning all Russians? Is this a concern? Are they going, above and beyond the sanctions?
Well, I think at this stage, banks are very eager to implement the sanctions properly. And these were very, as you know, a very broad range sense of sanctions that were decided very decisively and very quickly. So banks are trying to figure out how to implement them properly on all its areas of relevance. I think that you're absolutely right that as they move in this, they're probably more cautious than not, in the sense that they want to make sure they have swift implementation of the sanctions, and that may end up excluding some of their activities. Also, it's also true that some of banks are decreasing their risk appetite to Russian exposures or Russian-related exposures.
Thank you so much, Jose Manuel Campa, there, the chairman of the European Banking Authority, with clarity explaining the exposure of some of the banks on the back of the publishing, of course, that analysis. Now, we'll have plenty more here from the riverbanks of Lake Como. Coming up, we'll be speaking to the chief executive of Ambrosetti. We'll talk about inflation. We'll also talk about how Italy, this country with huge exposure but also huge links to Russia, is dealing with that. That interview with Valerio De Moglia is coming up shortly. You can also send in your questions on IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in Cernobbio, Italy, on the riverbanks of Lake Como. Jeff, thank you so much for sticking around. We're back with Jeff Yu, Senior EMEA Market Strategist at BNY Mellon. Jeff, how difficult is it for the ECB right now to set policy? We'll be speaking to Klasgenoot of Netherlands, and for such a long time they said, well, they didn't have the inflation problem that we're having in the US, but certainly the supply shock changes everything.
I think right now the bigger problem is the inflation expectations problem. For so long, for the last decade, we've been worried about inflation expectations being de-anchored to the downside, things falling too much. Now they risk very sharply de-anchoring to the upside. And this really has hit not just the ECB, but global policymakers as well. And if you look at how the yield curve is behaving, then clearly there's going to be a sense that the ECB is going to be a bit behind the curve, especially if inflation continues to behave the way it is. So how do you regain the initiative? How do you bring back that narrative? That's just going to be absolutely essential, not just for markets, but for European households.
Jeff, I know we're looking, of course, at the price of oil with that big release of stockpiling from the U.S. and, of course, the U.S. jobs data. What are you expecting from the U.S. policy, and how does that impact Europe?
Actually, if you look at the energy price side of it, those are headline inflation components. Right now, we're looking at the jobs data. If we get a strong enough print in terms of average hourly earnings on the 5 handle, say 5.5 or even close to 6, then real wages in the US, if you compare that to core PC, real wages are really going up. You have a demand push. That's something that the Fed will be looking at much more closely. They're not ruling anything out right now. 50 basis points per meeting for several meetings. I think that's got to be something that the market will be shifting as its core scenario.
Jeff, thanks so much. Jeff Hughes, Senior EMEA Market Strategist at BNY Mellon, joining us from our London studio. Coming up, we'll be speaking to the Chief Executive of Ambrosetti here at the conference where I am to maybe do a bit of game theory on what would happen if there's an oil embargo, whether some of the European countries would have to ration, of course, energy consumption. We're back with Valerio De Mogli. This is Bloomberg. Biden's record oil release, the U.S. president's plan to tap strategic reserves, risks undermining his green credentials while crude prices continue lowering. Putin's gas ultimatum, well, the Russian president demands buyers to pay for fuel in rubles or else European gas prices fluctuate. And stay with Bloomberg TV. We have a fantastic lineup of guests from the Ambrosetti Forum here on the riverbanks of Lake Como, including the Dutch Central Bank Governor Klaas Knot and the EU Commissioner for Financial Markets, Gerard de Guinness. You can send in your questions on IB Plus TV. Going shortly, a conversation with the Chief Executive of Ambrosetti, Valerio De Mogli. Now, good morning and welcome to Bloomberg Surveillance Early Edition. Do not be fooled by the beautiful, beautiful background. It is freezing here in Italy. The conversation focused on energy supply, focused on inflation, and of course on what happens with food prices. I'm Francine Lacqua here in Cernobbio, Italy for this year's Ambrosetti Forum. Now, first thing is first, though, let's check in on the markets. Danny Berger is in London with the latest. Danny, what are you seeing?
Francine, it really continues to be all about oil. WTI below $100 a barrel. We're seeing a second day of losses in oil after the SPR release from the Biden administration, saying it officially yesterday. Now, that is enough to lift stocks today, although it did not lift them enough yesterday. A historically bad quarter across the board for assets, save for commodities in Q1. We're looking at S&P 500 futures up 0.4%. Francine, it's also jobs day as well. So we are seeing yields push higher, but the yield curve is steepening now at 2.5 basis points. It was negative at the close of yesterday. And gearing up for that jobs day, there is this buying of dollars, but the worst performing G10 currency, it is the yen. Yen weakening against the dollar by 0.7% as the BOJ continues to buy bonds, and that yield differential weighs on the Japanese yen, Francine.
Danny, thank you so much. Now, President Biden has been defending his energy plan. He says the plan to release 1 million barrels of oil a day from U.S. reserves over 6 months lays a foundation for the country to achieve independence.
Today, I'm authorizing the release of 1 million barrels per day for the next 6 months, over 180 million barrels for the from the Strategic Petroleum Reserve. This is a wartime bridge to increase oil supply until production ramps up later this year.
Well, the OECD says the world is underestimating the impact of the war in Ukraine this month. The Paris-based organization estimated that the conflict's effects will shave 1 percentage point off global growth this year. Well, the OECD's chief economist, Laurence Boone, told me earlier this morning that the uncertainty deters consumers and investors.
I really believe we're underestimating the medium-term impact of this war. We will have consequences, longer-lasting consequences on energy security, food security, I think digital security, payment system security, trade.
So to talk about all of these uncertainties, I'm now joined by the chief executive of Ambrosetti. He's effectively the organizer of this wonderful conference, Valerio De Mogli. Valerio, thank you so much. It's so nice to be back in person. I know a lot of the participants are happy to be back. It's also very nice of you to having turned off the temperature in Italy by about 6 degrees. So we really talk about energy consumption. How worried should we be about inflation and the fact that we don't really know where this energy fight with Russia ends?
First of all, thank you, Francine, to you and your team for being back with us here. Yes, we tuned the weather on the economy, so we are freezing like the economy is freezing as a consequence to the war in Ukraine. And energy is one of the issues, but not the only one. Italy with Germany are the two countries with the highest negative impact. 41% of all the gas imported in Italy is from Russia. And as a matter of fact, Mr. Putin is still getting 1 billion check every day of euros to supply gas and oil to the European countries.
What happens if it stops? If we have an oil embargo, which we've never had, and I know there's various countries saying that they will adjust in this way or the other, but are we going to have a shock that could lead to a recession? Or are we underestimating the impact, the profound impact this could have?
Well, as a leading think tank in Italy and number 4 in Europe, the European House Ambrosetti is dimensioning the impact very severely for Europe. We are much more negative than the OECD forecasts, for instance, and we foresee for Italy only 50% reduction of the previous estimate of growth. Say that 2022 GDP growth was supposed to be up to 4.5%. We now believe will not be much higher than 2%. So, of course, it depends very much on the duration of the conflict and on the further consequences we will have.
Can Europe and can Italy spend its way through this? So there's been huge fiscal support during COVID. We also have now refugees that we need to take care of with fiscal spending and trying to house them and give them a proper education. What does it mean for the purse strings in countries like Italy?
Well, the supply chains of a number of manufacturing industries are severely affected. Takes the steel manufacturing, 50% of the raw materials, coke, for instance, nickel and others are coming from Ukraine and Russia. Combined, 64% of the corn and of the maize are imported from Russia, Belarus, and Ukraine. And so that's going to affect also the food industry. Fertilizers, 50% of them are coming from Ukraine. So the impacts will be very severe. And also, as you said, on the humanitarian side, 2 million of refugees are hosted by Poland only, and 90,000 in Italy.
I know you don't have to deal with the markets every day, but it is surprising to many that the markets, even if they realize this, still seem to be going up. How does this end in terms of cost of living? If you look at the possibility of recessions, the possibility of again the longer-term deficits, what's the main challenge for Italian politicians right now?
Yes, this is a very good question, and the impact will be very severe on the poorest families, particularly in the southern of Italy, but not only in Italy. That will be all across Europe, and the impacts will be asymmetric. And unfortunately, the poorest classes will be touched the most. In terms of the Italian government, I don't think there will be any change before elections next spring, and we expect that there will be a Draghi continuation, at least up to the next spring.
Valerio, did you do any modeling or gaming about rationing? So if the energy crisis gets a lot worse, will countries and will the Italian government have to choose who can use energy and who can't?
Well, as a matter of fact, we made a plan for the government already, trying to simulate impacts and alternative possibilities. And yes, I think we can sort out the problem in Italy in 1.5 to 3 years' time. So that will not be something resolved overnight, but it's not an incredible problem with no solution. We will have the southern pipeline to Mazara del Vallo from Algeria will be potentiated, and that may even double the size. And that solution only will sort out 1/3 of the problems from Russia. And then the other 2/3 may be resolved with agreements with other African countries as well, different geographies.
Valerio, thank you so much. As always, now that we've frozen Valerio, you can go back into the warmth of the conference. Valerio De Moli, the chief executive of the Ambrosetti European House, of course, the organizer of this conference. Now let's get straight to the Bloomberg. First World News in London is Angel Feliciano. Hi, Angel.
Hi, Francine. Ukraine says talks with Russia are set to resume today. This as the United Nations warns relief convoys have so far failed to reach Mariupol, the port city devastated from weeks of shelling by Moscow forces. Meanwhile, the International Atomic Energy Agency says Russia has agreed to hand back control of the Chernobyl nuclear plant to Ukraine. Shanghai has started the part 2 of its phased lockdown, confining some 16 million people living in the western part of the city to their homes. Phase 2 follows the lifting of the 4-day lockdown in the eastern half of the city, although the restrictions will continue at some buildings where infections were recorded. President Putin has unveiled payment terms for Russian natural gas supplies in the continuing row with European consumer nations. From today, foreign buyers will need to open special ruble and foreign currency accounts with Russia's Gazprom bank to handle payments. A French official says the new mechanism doesn't change payments as mandated in supply deals, which will continue as before. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny, Fran.
Thank you so much, Angel. Now, coming up, the price of power. Millions of UK households will see their energy bills surge by 54% from today. We get the details and look at what it means for inflation and the Bank of England. That's coming up next, and this is Bloomberg.
That the market is increasingly concerned that the Fed will make a policy mistake, and the markets are accordingly say, just pay attention.
Okay, pay attention. Do you worry that a 50 basis point hike from the Fed is actually the wrong message because it suggests panic and too many questions about what happens next?
Look, I worry that we're in a no-win situation. I worry that the Fed now has to choose between one of two mistakes and has to decide which one it would rather make.
Okay.
Go too fast or go too slow. I would go too slow. That's a mistake I would make. But I understand that a Fed that has lost credibility may want to go too fast.
Okay, but because what do you worry about? That if they go too fast and they have to reverse it, which is what we've seen in Europe about 10 years ago?
I worry that they'll tip us into recession. That's what I worry about. That they are late, that they mischaracterized inflation for too long, they didn't do enough. And now they feel that to regain their credibility, they have to show, and they hike twice by 50 basis points.
Yeah, Mohammed, Danny also has a couple of questions for you.
Yeah, Mohammed, good morning to you. Thanks so much for joining the program. And you've been very clear of your fears over recession. Earlier this month, you called for the potential of double-digit inflation figures. Does an SBR release from the Biden administration and lower oil prices this morning relieve any of those fears for you?
It helps, but it doesn't remove them. I think that the distribution of outcomes has shifted. Stagflation used to be a risk. It's now a baseline. Goldilocks used to be the right, now has moved to being out completely of the distribution. And in the left tail, recession has come in. I don't think that the release of the oil will significantly change that distribution.
Our interview earlier with Mohammed El-Erian, Chief Economic Advisor at Allianz and Bloomberg Opinion Columnist. Now let's talk a lot more about the energy prices. Households in the UK waking up this morning to a far higher cost to heat their homes. British energy regulator Ofgem has raised the cap on how high consumer prices can increase by 54%. Well, joining us now is Bloomberg's UK economy reporter, Lizzie Burgeon. So, Lizzie, the price increase that's coming in today, it is a big deal. Who's going to have the most impact on?
Well, the poorest households in Britain, Francine, are going to feel this the most. They wake up today to find that the price of boiling the kettle or taking a shower has gone up massively because, as you say, Ofgem, the energy regulator, has increased its price cap by 54%. It estimates that that'll impact 22 million households. And combined with the tax rise that's coming in today, the Resolution Foundation says that it will cost the average household £1,100 more over the next year. So this is set to be the biggest squeeze in living standards in more than 50 years, according to the fiscal watchdog, the OBR.
So how is this price increase likely to impact inflation, Lizzie?
Well, the Bank of England says that inflation could hit double digits this year. It's largely driven by the war in Ukraine. You've got wholesale gas prices 6 times where they were last year. And that means that the Ofgem price cap could rise again in October this year, some analysts say by 30%. And overall, this rise in inflation is swallowing wage growth, weighing on consumer confidence, and it just raises the risk of a recession in the UK.
So how does this complicate the outlook for the BOEM Treasury?
Well, Rishi Sunak, the Chancellor, has come under immense criticism since his budget last week for not doing enough to support the poorest households. Even some of his own MPs have said that he's going to need to do more to cushion the blow, despite his ambition to balance the books. For the Bank of England, it has its own headache. It's already raised interest rates 3 times. It says there's nothing it can do about the short-term crisis. But if it hikes more aggressively, it risks adding to the pain for consumers and triggering a recession itself.
Thank you so much, our Bloomberg UK economy reporter, Lizzie Burden. Now let's get straight to the Bloomberg Business Flash with Angel Feliciano. Hi, Angel.
Hi, Francine. The U.S. House has moved forward a key piece of President Biden's drug pricing agenda. Lawmakers voted to limit what patients pay for insulin to $35 a month. Approximately 30 million Americans are living with diabetes. But according to a study, they pay as much as 5 times more for a unit of insulin than people in other high-income countries. Gamestop shares surged in late trade after it announced plans for a stock split in the form of a dividend. At its upcoming annual general meeting, the retailer will seek shareholder approval to increase the number of Class A shares to 1 billion from 300 million. It says the split would provide flexibility for future corporate needs. And that's your Bloomberg Business Flash. Francine?
Angel, thanks so much. Now, coming up, a new wave of COVID infections is highlighting the growing cost of China's zero-tolerance policy. We discuss that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Cernobbio, Italy at the Ambrosetti Forum. Now, Euro area headline inflation due in a few minutes from now. The print set to reach the highest since the inception of the euro, primarily driven by, of course, a spike in energy prices. Bloomberg Intelligence actually estimates a 7% figure year over year. Also out today, traders will be closely watching U.S. unemployment figures. Now, let's get straight to COVID. China's COVID zero strategy has been drastic but effective, saving lives and keeping the economy on track. The new wave of virus cases is highlighting the growing costs of the approach as well as the perils of any attempt to change it. So we talk China and COVID with our Sam Fazeli. He's our Bloomberg Intelligence Director of Research. Sam, first of all, I mean, it's getting now tricky, especially because the rest of the world is opening up, that China is sticking to a zero COVID policy. What are they worried about? Is it not enough vaccinations? Is it vaccinations, the Chinese one, that works less than, for example, mRNA?
Hi, Francine. I would say it's probably all of the above. You know, the number of people and the closeness of and the tightness of that community, if the virus were to get out of hand, combined with vaccines which are effective, but perhaps not as effective as some of the vaccines that we've been lucky to have in the West, such as the mRNA vaccines. That combination is not a good combination, especially with the variant Omicron, because it's so easy easily finds people who are in whom he can basically knock out their immunity and infect. So that is, I think, the biggest problem that they're thinking about.
So, Sam, how does this play out? Is there, again, I know for us here in a lot of countries where most of the people have been vaccinated, this feels like a cold. But actually, you were telling me that Omicron can still be very dangerous. What does the healthcare system in China need to do to try and prevent too many deaths?
Yeah, I mean, Francine, the easiest way, of course, is to keep people apart. But that doesn't work for society. That's not how humans are designed, and our economies are not built like that. So we can't do that. And that is what I think China is still trying to do in here. The best way, the easiest way to manage it, which will have a human cost, there is no zero cost methodology here or system that they can use. The best way would be to have a vaccine, which in the West is the mRNA vaccines at the minute, that give you a significant enough boost that protect you against severe disease, and then see how opening a society or a region goes ahead. Try that and see whether you can manage the run on hospitalization and hospitals that you would probably get. Yeah. I think that's the only way out.
But Sam, are there any talks between Chinese authorities and the makers of the mRNA to get those vaccines in the country?
Well, so China does have other vaccines that have been developed that could have the same benefit as the mRNA vaccines. But the data that we have today suggests if you take a shot from BioNTech or Moderna, on top of even the CoronaVac they've been using, you get a great boost. And in China, BioNTech has partnered with Fosun to deliver vaccines, and they've filed for approval, I guess, about 6 months ago now. So that's up to the Chinese authorities to get that approved and used. And then, of course, you have to get the doses.
Yeah, Sam, what can you tell us about some of the policies in the UK, much more liberal? I mean, I landed yesterday, of course, in Milan to make my way to the riverbank of Como, and it's a very different approach to how you deal with Omicron here. Masks are required, certainly inside, sometimes even outside. Like, what approach makes more sense? What are we now trying to do in a lot of these countries where the vaccination level is quite strong?
Yeah, Francine, you know that I've always been a fan of these masks, especially if they're good masks. I think that's just such an easy way to reduce the risk of an infection and spread of infections, especially on public transport, etc. So that I don't understand. Taking away free tests, I don't understand. But trying to get back to some level of normal and living with the virus, I do understand. My biggest worry with high levels of infections is the problems with long-term symptoms. That's the biggest worry, and I think that's going to be something to really watch for in the next few months.
In 10 seconds, are we going to need a fourth shot?
I think people over the age of 60, somebody over the age of 65, 70, I think that's a good idea.
All right, Sam, as always, thank you so much for joining us, the Director of Research at our Bloomberg Intelligence and a real expert in coronavirus and some of these vaccinations, our very own Sam Fazeli. Well, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz in New York, or Anna Edwards in London. We'll have some great guests line up. I'll be back also with Ellen Zentner. We'll talk about, of course, the U.S. jobs data. We'll talk about the oil release and what that means for oil prices. And if you have an oil embargo, we could see it. What does it mean for possible rationing of energy? This is Bloomberg.
I actually think one of the things coming out of this crisis is going to be a new equilibrium.
I really believe we're underestimating the medium-term impact of this war.
The market is increasingly concerned that the Fed will make a policy mistake.
The geopolitical situation, the energy situation is very severe.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Friday, April 1st. Our top stories today. It's Jobs Day in the U.S. Economists surveyed by Bloomberg say it was another strong month despite the pandemic and problems in the global supply chain. Ukraine strikes back. Helicopters cross the Russian border and attack a Russian oil facility. Meanwhile, peace talks may resume today by video conference. And natural gas prices in Europe are fluctuating. Traders are trying to assess Russia's decision to demand rubles in return for its energy supplies. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. And Kailey, there's a little more sense of normalcy in these markets, if that is at all possible, given what is going on geopolitically. We are in limbo here on European equity markets as we wait for the jobs report in the United States.
Yeah, just about 3.5 hours to go until we get those numbers, Anna. So the market waiting to see how exactly it's going to start off the second quarter. In Asia, wasn't the best start to the quarter. You did have equities mostly lower. The MSCI Asia Pacific Index was down by about 0.4%. One outperformer within that, though, was China. The CSI 300 actually rising 1.5%, so a bit of an outlier there. That was really a move led by consumer stocks in particular. And then in other asset classes, of course, you're seeing selling pressure in the global bond markets today across countries. It was true in New Zealand, where the two-year yield was up 7.5 basis points at 2.967%. That is the highest for that yield going all the way back to June of 2015. Finally, just wanted to point out, after a couple days of strength, it is back to weakness for the Japanese yen, weaker against the dollar by about 0.7% today, Matt. We are back at that 122.54 level.
All right, getting back in a little bit to normalcy, as Anna says, we're seeing S&P futures up about 0.4%. So after the drops that we've seen over the past 3 days, I think the past 2 days, we're down about 1.5%. The 10-year yield at 2.4134 right now, and real yields are getting back up closer to that zero level. You're going to get a lot of talk about that today, although it's still down to negative 41 basis points on real yields. NYMEX crude trading just about $100 even, 99.83 a barrel for Texas Intermediate, and Bitcoin off 1.4% to 45,126. So this may be a little bit of a risk-off indicator, and that could have something to do with the European inflation headlines coming in hot.
Yeah, absolutely. Talking about things that are normal and not transitory then anymore, Matt, it seems to be inflation numbers that come in hot and beat estimates. So euro area inflation rate jumping to 7.5%. The estimate was 6.7%. So once again, we find ourselves within an inflation print from the euro area that's coming above estimates. Is the surprise not a surprise because we're quite used to that now? But these estimates, they do take some time, don't they, to reflect the reality. This is what we see on the European equity markets right now, a focus on a little bit of risk appetite. But to your point, Matt, about early warning indicators, not much conviction in this early morning trade, it would seem, here in European markets. A little bit of tentative move to the upside as we wait for data out from the United States later. There's a real focus on what's going on in bond markets as well. We know about the inflation impulse in Europe, and that seems to be something that we're embracing once again on the first trading day of the second quarter of 2022. We are once again seeing selling of fixed income and bond yields on the rise. And I put in the German Bund, but this is the case across the European space right now. Brent crude to complete the picture there. After that big drop we saw in the oil price as a result of the SPR release, how long lasting will that be? We're still down at 104, the handle now on Brent, down another 0.1%. We've been lower than that, though, earlier on in the session through the Asian trading day. This is the natural gas price in Europe, and it's interesting to see that this is dropping today. It's been really volatile, of course, so we shouldn't read too much into one day's moves, but there's a lot to be nervous about here with regards to how exactly European countries are going to pay for energy from Russia, using which currency, how that geopolitics and those demands play out. Also focused on the flow of gas, but we're cautioned by some of our colleagues not to read too much into the daily technical headlines about the way that the gas moves around Europe. We'll get to that story with an expert guest later on. I put in Sodexo. This is a catering and business services business. The stock down by 7.8%. They were forced to revise down expectations as a result of both the war and also the lingering effects of COVID-19 then, Kailey.
All right, Anna, and we see Russian stocks moving to the upside as well. The ruble trading right around that 82 level. Now, a look at what else we are watching today. Chicago Fed President Charles Evans will be speaking at 9 a.m. New York time. Surely we'll get his remarks on the jobs report. Then on the ECB side, Isabel Schnabel and Klaas Knot will be speaking at an event in Italy. And then on that jobs report, that will be coming at 8:30 a.m. New York time. Economists surveyed by Bloomberg are expecting another strong number on payrolls. The median estimate is that employers added 490,000 jobs in March, while the unemployment rate is expected to fall 0.1% to 3.7%. Mike McKee, Bloomberg International Economics and Policy Correspondent, joining us now for more from Washington. So, Mike, what are you looking for today?
Well, Kailey, this is going to be more of a trend report than a groundbreaking report. What the Fed and everybody wants to see is whether the trend in strong labor market growth continues. As you mentioned, we have a fairly strong forecast of 490,000 with the unemployment rate dropping to 3.7%. But we did see more jobs than expected the last time. Does that continue? Is the labor market as strong in March as it was in February? But it's the earnings and participation rate that are going to really capture attention today because the Fed, as it begins tightening, is worried about a wage price spiral. Average hourly earnings expected to be higher on a year-over-year basis last month than they were in February. The participation rate just ticking up. And here's why that's important. If we see the participation rate continue to rise, more people coming into the labor force, that puts less pressure on companies to raise wages. You can see what's happened with leisure and hospitality and with goods manufacturing, factory floor wages. They've gone down. The increase has been smaller, put it that way, each month as more people have come back into the labor force. And that's what we want to see today is the labor force still attracting people to come off the sidelines and ease some wage pressure.
I wonder what we expect from the Fed, considering all of that. I mean, I know everyone now is betting on 50 basis point hikes. Is that, consistent throughout the rest of the year, or are we talking about just 1 or 2 50 basis point hikes?
Well, that'll kind of depend on the data, Matt. If we have several months' worth of strong labor market data, it's probably going to push the Fed to do more 50s. They've pretty much locked in the idea of 50 in the market's mind, and they'll want to ratify that in May if the numbers don't surprise significantly, and there's no reason to think that they would. We will hear from Charlie Evans shortly afterwards. It'll be interesting to see his take on it. But probably what you'll hear from the Fed is that the labor market is strong, and we are on the same path we were before the report came out.
Mike, thanks very much. Bloomberg's Mike McKee with us. The focus on the labour market then as we go through the day. Staying in Washington, today's jobs report comes as President Biden faces his party's biggest headwind, persistent high inflation. Biden made a big bet on lower gas prices. He's ordered an unprecedented release of oil from the U.S. Strategic Reserves. Emily Wilkins, Bloomberg government reporter, joins us now. Emily, what may happen if Biden's strategy works, or tell us what happens if it fails? I mean, this is coming ahead of a key political test for the administration.
Absolutely. I mean, the Biden administration is under immense pressure right now to find a way to lower gas prices, something that's really only partly in their control, but Americans still very much blame the president for. And look, that midterm that's coming in 8 months, generally, historically, midterms are always worse for the party that's in power. So this was never going to be easy for the Democrats, but it gets worse the worse a president's ratings are. Biden's approval rating is at a low of 42% right now. And even though the administration has been trying to push this narrative that these higher gas prices, that you need to blame Putin, that you need to blame big oil companies, voters aren't buying it. According to a Quinnipiac poll that was released, more people blame Biden for these high gas prices than, say, Russia or big oil. So this is really an area where Biden needs to reverse course, or his party could face even bigger losses than expected in the midterms. Yeah, the most visible sign of inflation when you literally see the price pasted at the gas pump. Thank you so much to Emily Wilkins of Bloomberg Government in Washington. And don't forget to tune in later today, our Jobs Day coverage with Marty Walsh, U.S. Labor Secretary, among others. Now let's get to the latest on the war in Ukraine. Russia said 2 Ukrainian military helicopters made a rare strike across the border. Virtual talks between the two sides will resume today. Meanwhile, the EU is warning President Xi Jinping of China that it will hurt its global role by helping Russia. Let's get more on the EU-China summit with Maria Tadeo, our European correspondent, who joins us from Budapest. All right, Maria, what do we know about what these two sides are saying to each other?
Well, Kailey, what we know is that this call is still ongoing and will probably go on for a couple hours still. Now, the message that the European Union wants to give China today is that it has a big role in this world, it has a big economy, and therefore should use that influence to bring Vladimir Putin from the brink and put an end to this war, that China should in some ways use that influence to end this conflict. Now, the other thing, of course, is that if that's not the case, then the European Union wants to warn the Chinese that there could be repercussions. If you help actively or passively, that could lead to potential sanctions. They don't specify what kind of sanctions it would be. They say this is strategic ambiguity, but that is a warning very similar to that of the United States. And then the third thing to watch out for is the EU-China trade deal. Remember, in 2020, Angela Merkel signed a trade deal with the Chinese, then it failed to be ratified, and it's been put in the freezer for 2 years. For many, this is now dead, especially because we've seen a lot of tensions between the Chinese and the Europeans over state aid, and it's going to be impossible to resuscitate. But that is the other big question going into this meeting that, of course, has focused majorly on Ukraine.
I wonder about the pushback we're getting from European leaders about paying Vladimir Putin for gas in rubles. Putin said, you know, if they don't agree to his new terms by today, he's going to cut them off. Are we going to start to see, European leaders try and nuance workarounds, like say they're paying in euros, even though they're using Putin's bank and exchange rate to actually pay in rubles?
Well, that's what they're doing for the time being in many ways. You pay in euros, and then, of course, it's up to Gazprom and its financial branch to decide whether or not it wants to convert it into local currency. But what European officials say is that they're not going to divert from anything that is a direct payment from those contracts into Russia and change it, swap it, and not pay in euros. We heard yesterday from the Germans, we heard from the Italians, also the Italians, and in particular Mario Draghi. He said he was very confused about the payment system that Vladimir Putin spoke and told him and explained to him for an hour. Mario Draghi says that it's very difficult to change a contract while it's active. And then, of course, the French, however, saying we have to prepare for everything. He could cut the flows. That is potentially an option and a possibility, and we need to come up with a plan B. What's a plan B? We still don't know. The one thing I would say, Matt, I'm in Budapest, and here you can watch Russian TV. Remember, the satellite signal was supposed to come down, but here in Budapest, it's not a problem. And I was watching Russian TV yesterday. They played this video of Vladimir Putin saying this is Russian gas, so therefore they should pay in Russian currency. And the star presenter lashed at Olaf Scholz, saying, I've never seen a chancellor like this. He's going to take Germany into financial and economic collapse. So that is the way that Russians look at this, and they interpret this when they watch the news. Of course, very different to how we look at it in the rest of Europe.
Maria, thanks very much. Maria Tadeo, our European correspondent in Budapest, as she mentioned. The reason she's there, of course, is she's monitoring Hungary's elections, which take place this weekend. The Premier, Viktor Orban, is tipped to win a fourth consecutive term. That vote happens on Sunday. Now, stocks wrapped up their first quarterly loss in 2 years, while Treasuries saw their worst quarter in at least 5 decades. Let's get more with Bloomberg's Danny Berger. Danny, the events we've seen in markets are kind of historic, I suppose, in the first quarter, but really because of the confluence of bad performance we've seen across so many asset classes, except for commodities.
Exactly. It was a historically bad quarter, one for the record books, though one probably investors wish that they can forget. So the scores on the door, 5% declines for both stocks and high yield, 5.5% for treasuries, nearly 8% for investment grade debt. So if you put all those 4 asset classes together, you get the worst quarterly performance since 1980. And to your point, Anna, there wasn't anywhere to hide out unless commodities, which skyrocketed higher. But of course, they've been extremely volatile, and just their move higher was part of the reason we saw this big dent across asset classes, because of the pressures from war, because of the specter of higher interest rates. So what does this mean going forward? Are any rallies from here? Are they just a bear market trap, or is the bottom in, and can we outperform for here? Now, trying to predict the end of the year is always a very difficult and perhaps a fool's task, especially now with so many uncertainties. But we still do have an analyst average of 4,900 thereabouts for the S&P 500. That's a gain of about 8% from where we are. But we are starting to see some warning signs creep into analyst estimates. The average change of a year-end target from the start of the year is down about 1.5%. So even though it's just small at this moment, Kailey, we are starting to see hints of bearishness creep into Strategist updates.
It always seems, Danny, that strategists are playing a constant game of catch-up, either to the upside or the downside. Thank you so much to Bloomberg's Danny Berger. Now let's take a look at some stocks moving in pre-market trading here in the U.S. I want to begin with Gamestop, the big outperformer before the bell, up 15% after the company said it's going to ask for approval from its shareholders to split its stock in the form of a dividend. This seems like it's becoming a pattern. You have Alphabet, Amazon, Tesla, all announcing similar hopes in the recent weeks. So Gamestop is reaping the benefit of that today. Another stock moving to the upside is Robinhood. Apparently, it's getting ready to launch retirement accounts on its app. That news broken by Bloomberg late yesterday. That stock is up about 3%. Sinking lower, though, Blend Labs. This is a software company missed on first quarter and full year revenue estimates. A couple of analysts cutting their price targets on the stock as a result. It's trading at $4.30 this morning, down about 25% before the bell, Anna.
Coming up on the program then, Kailey, live from the Ambrosetti Forum in Cernobbio, Italy. We will be speaking to Morgan Stanley's chief U.S. economist, Ellen Zentner. Francine Lacqua will be bringing us that conversation a little bit later, in fact, very shortly on this program. A lot to focus on ahead of the jobs report. We'll also be talking to Biraj Bhaukataria, RBC co-head of European Energy Research. We can ask him all the things we do not understand about the way that the European gas market is operating right now and what Russian demands really mean. A new wave of COVID infections is highlighting the growing cost of China's zero-tolerance policy. You can read all about that in today's Big Take story. Check out NI Big Take on the Bloomberg terminal. This is Bloomberg.
I worry that the Fed now has to choose between one of two mistakes and has to decide which one it would rather make.
Okay.
Go too fast or go too slow. I would go too slow. That's a mistake I would make. But I understand that a Fed that has lost credibility may want to go too fast. I worry that they'll tip us into recession. That's what I worry about. That they are late, that they mischaracterized inflation for too long, they didn't do enough, and now they feel that to regain their credibility, they have to show, and they hike twice by 50 basis points.
Bloomberg's Francine Lacqua speaking with Mohamed Al-Arian, Bloomberg opinion columnist, earlier at the Ambrosetti Forum in Cernobbio, Italy. Now, for more on this event, Francine is there with top U.S. economist at Morgan Stanley, Ellen Zentner. Francine?
Yeah, thank you so much, Kailey. I could not be more happy to meet Ellen Zentner right here in the riverbanks of Lake Como. It's beautiful, but very cold. Ellen, the conversations, though, are really about a possible freezing of energy, the impact this has on inflation, and, of course, what the U.S. Fed does. So thank you so much for joining us. Yeah. Is a 50 basis points hike from the Fed problematic in terms of communication, in terms of giving a message to markets that there's a panic, and would they have to reverse it if inflation then cools off?
So I think there's a good deal more financial conditions tightening that we can withstand in the U.S. The Fed's basic problem is that they need to create slack in order to bring inflation down. So I think we're already seeing in market pricing that they're fairly comfortable with the idea that the Fed could go 50. Now, with a Fed that doesn't provide a lot of forward guidance, really that does not provide forward guidance, has to know that when you go 50 basis points, you do open the door for more 50s delivered after that. But I think they're comfortable with the message that we are going to be aggressive. It's just going to be a lot of volatility this year because we don't know when and by how much they're going to raise rates at each meeting.
So does it make sense to front load, though? So could you see a 250 basis point hikes and then wait and see for a couple of maybe months?
Yeah, so our expectation is they do front load 50s. So at the May meeting and at the June meeting. And then they move into sort of this comfortable 25 basis points each meeting. No. But it could go well beyond that. I mean, you do want to hike while inflation is highest. It is about credibility, and Chair Powell wants to maintain it. He's the first chair since the 1970s to fight to bring inflation down rather than take inflation up. And he is willing to make a policy mistake if that's what's needed, because he's confident he could be nimble to course correct if needed in 2023.
Ellen, given the possible oil embargo, the repercussions, I know Europe suffers first, but then this kind of feeds back into the U.S., the second and third round effects of freezing out Russia. When you look at what the Fed policy is, what does it mean for King Dollar?
So the dollar is going to stay stronger here. I mean, you've got central banks, developed market central banks, that are all reducing the balance sheet, moving more hawkishly, at least in communication, if not already in policy moves. And someone's going to be dissatisfied with their plans. And most likely it's not going to be the Fed. I think the Fed is sitting on an economy that's in the best position to absorb higher interest rates. And I do think since Russia-Ukraine impacted Europe much more disproportionately than the U.S., I don't see how that doesn't result in a stronger dollar, weaker euro.
On the U.S. economy, Ellen, obviously that is one that is powered by the American consumer. And when you look at the spending data of yesterday, adjusted for inflation, a larger than expected drop-off in February. Are we starting to see the first signs of demand destruction due to higher prices?
Yeah, I think it's a great question because even back in November, we saw consumer surveys show that the concern over inflation rose much higher than the concern over COVID. It is especially painful in the U.S. for lower-income households. They're not just dealing with higher energy prices and higher food prices, but higher rental prices as well. And so what we're seeing is that the consumer is getting much weaker at the lower income levels, but holding up quite well at the upper income levels. And that means that you do need a much more targeted response to help alleviate that burden, targeted toward the lower income households.
Do you expect those inflation pressures to drive more people back into the labor market? And how does that filter through to your expectations for today's jobs report?
So I think that higher inflation will certainly keep wage bargaining alive. I mean, there's every evidence historically that it's higher prices that lead to higher wages because you go in and you demand higher wages. And we've already seen the pressures just from a lack of labor supply. So I think wage pressures remain. I do think that the Fed is wanting to battle aggressively against inflation because if you don't bring inflation down, then wages will not outpace inflation no matter how high they are, and that creates a weaker demand backdrop. I think in the labor market report today, we're going to continue to see wage pressures that are there. I think a pickup in labor force participation, and we're expecting about 550,000 jobs created over the month. It's been an incredibly robust, stable pace of job gains each month, and that alone still supports the economic backdrop for demand in the U.S.
Ellen, concretely, what do does the release of the oil stockpiles, is it a political message or does it actually make a difference to inflationary pressures?
So I think the desire, of course, is for it to make a difference. But I think that because oil prices are globally determined, I don't think it's going to have that big of a sustained impact on getting prices lower, at least more notably for households in the U.S. It is certainly a political message as well, though, because it is number one on the president's agenda, getting inflation down. High inflation can be a campaign killer, and here we are in midterm elections. And so you need to get inflation lower, but there's only so much that the administration can do directly, more than just jawboning around it.
So what does that mean for fiscal policy in the U.S.?
So fiscal policy for the U.S., I think that part of the campaign message will be whatever they can do in order to get inflation down. I think the Fed has heard that message as well. It happens to also be a strong desire of Fed policymakers in order to get inflation down. But inflation will be written all over this election.
Absolutely. Thank you so much to Ellen Zentner of Morgan Stanley and Bloomberg's Francine Lacqua in Cernobbio, Italy. And of course, on the subject of inflation, I think it's the wage data, maybe perhaps, Matt, that the market is going to react to most today.
Yeah, absolutely. Looking out for Mike McKee earlier was talking about the price wage spiral. That's the concern. Coming up, Daniel Morris, Chief Market Strategist at BNP Paribas Asset Management. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Economists surveyed by Bloomberg expect another strong U.S. jobs report today. The median estimate is that employers added 490,000 jobs in the month of March. The unemployment rate's expected to fall 0.1% to 3.7%. Ukraine says direct talks with Russia are set to resume today. These negotiations will be by video link instead of the face-to-face setting. Meanwhile, Russia says that Ukrainian forces made a rare strike across the Russian border. 2 helicopters hit a Russian oil tank facility. And natural gas prices in Europe are fluctuating and really in focus. Traders are trying to assess Russia's decision to demand rubles in return for its gas. Foreign buyers will need to open special ruble and foreign currency accounts with a Russian bank. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, we're all trying to get our heads around what it is the Russians are asking for and what the Europeans are saying that they will do in response to those requests for how exactly Russian assets are paid for. We've got a great guest to talk about that later on. So what is coming up for you then? What do you see ahead of the US Open?
Well, I'm watching stocks that are rising or futures that are rising ahead of the US Open right now. S&P futures up now about 0.5%, and investors are selling off bonds, allowing the yield to float up to over 240 right now, 2.4005. Crude is also on the rise, just slightly above $100 for Texas Intermediate, $100.90 a barrel, so it's a gain of just over 0.5%. And Bitcoin is actually down right now, but still holding above 45,000 at 45,253. So in terms of U.S. markets, things look relatively stable. Kailey, what do you see in terms of the pre-market movers?
Well, I'm actually paying attention to a breaking news headline that just crossed. China is weighing giving the U.S. full access to audits of most firms. Remember, this has been a big issue in recent weeks. The U.S. mandating that you get audits of some of these Chinese companies in order for them to stay listed on U.S. exchanges. So maybe this is a little bit of progress in that direction after some hesitant remarks we heard from SEC Chairman Gary Gensler earlier this week. And as a result, you are seeing a lift for some ADRs of Chinese tech companies that are listed here. Alibaba up 4.27 or roughly 4%. Baidu is up by about 4.7%, so maybe a little bit of relief coming into those baskets of stocks. Also moving higher today, Robinhood. It's looking, getting near to adding retirement accounts to its app. It's up about 3%, and I wanted to check on the shares of Apple as well. 2 days of losses in the last two trading sessions, but that was after an 11-day winning streak. The stock is back moving higher today, up about 0.4% before the bell, Anna.
Yeah, Kailey, those lines then coming out of China, really interesting to get the SEC's take on just how substantial a commitment that turns out to be. We'll look for the detail there. This is the European picture then. European equity markets, to Matt's point about stability, waiting for the jobs report later on today. We've got a bit of stability here in the European equity session, up by 0.6% as we wait for that key data to hit. We had inflation data out for the Eurozone earlier, which came in well above the estimates. We've kind of got used to that being the trend. We certainly got used to seeing high inflation prints, and the bond markets continue to look ahead to a higher yield environment, and we've seen this across the European space on the first trading day of the new quarter, of course, this being April the 1st. I put in here German bunds, but we could have put in all kinds of different debt products across Europe because we are seeing a continuation of that sell-off in fixed income and yields moving higher. This is the natural gas price. This is really in focus because of the complexity of what we're hearing about the way the gas flows across Europe from Russia to Europe, or perhaps on occasion back again, and also what we're hearing about the Russian demands for payments in rubles. We'll get a guest on very shortly to explain a lot of the detail to us. But for the moment, we're seeing a little bit of a move lower, actually, in that particular price. This is the Russian market for you. The stock market is up by 2.8%. Another day of gains, the third in a row, I think, for Russian stocks. It seems that the Russian investors very much focused on the talks that are set to take place between Russia and Ukraine then, Matt, and what that could deliver. Of course, international investors maybe have modest expectations, but certainly that seems to be a talking point in Moscow.
Wow, a dollar buys 82 rubles. I wonder who's actually paying that rate, although maybe Europeans are. I'm looking at the discount that European stocks trade to U.S. stocks in a forward PE basis. The discount is now 35%. So the question is that too cheap to ignore? Do you go in and buy European stocks? Or are you concerned about the Russian gas pricing issue? And I mean, look, Anna, people in the UK are facing now energy bills that are going to jump by 50% overnight. That can't be good for stocks. Joining us now is Daniel Morris, Chief Market Strategist at BNP Paribas Asset Management. Dan, what are the risks here that these higher energy prices, or even the possibility of a cutoff, present?
Well, multiple risks potentially. If you think about, generally speaking, the better tone we've had for European equities recently, you imagine that's premised on two things. So one, that the conflict doesn't expand beyond the borders of Ukraine, which of course at one point was something we did worry about, and that the energy supplies keep flowing. Now, particularly the second one, we appreciate is volatile along with prices, and that could change. But generally speaking, I think the markets are assuming that that happens. So as long as the gas and the oil continues to flow to Europe, the economy should be able to weather it. Nonetheless, we do appreciate that almost with any of the scenarios we might imagine for the conflict, prices are going to stay high, inflation is going to stay high. And I think that highlights kind of the next risk that we may see, which is that we start to perceive that the ECB is behind the curve in the same way that we realize that the Fed is. And so are we going to have to start adjusting to higher rate expectations for the Eurozone? And we saw in the first quarter of this year what that can do to equity markets when we had the decline in the S&P.
Is this a market, Daniel, that is pricing in a substantial slowdown for the European economy, but not a recession? Even those who are pretty pessimistic on the way that Europe performs this year, reluctant to talk about outright recession at this point.
Well, I think it's not only reluctance, but we really are quite a long ways away from a recession. If you look at what happened back in 2010, 2011, you actually had a similar increase in oil prices from about $70 per barrel to 110, 120, and it stayed there for 3 years, which is quite different from, just a spike that comes back down. Now, back then, you actually did get a recession, but I think you'd argue that was much more because of the Eurozone crisis. And the key difference is back then, the annual rate of growth was about 2% per year for the Eurozone. Now we're about 4 coming into this. So even if we are getting those negative revisions to the outlook for growth, you're going from 4% to 3.3 and still 2.5 next year, which for the Eurozone is very high. If you look at the average growth rate for the Eurozone since 1995, it's 0.4%. So we're, I think, a long ways from a recession now. We do have a buffer, and I think that's what the important focus should be.
Daniel, in terms of the sectors you want exposure to, then maybe staying in Europe, but perhaps expanding over to the United States as well. Is it all about commodities? Looking back at Q1, commodities seem to be one of the few asset classes that had a relatively strong period. That doesn't necessarily bode well for the rest of the economy, but in terms of places to hide out from the inflation?
Well, on one hand, if we just think about kind of what parts of equity markets perform comparatively well when you have rates rising, you're exactly right. It is the commodity sectors that are the most resilient. I think the other sectors you can look at actually are small cap stocks in the U.S. historically have done well when the Fed is raising rates. So I think it's at least another area to consider. Though, to be honest, the markets that do the best when the U.S. is raising rates are non-U.S. markets. I mean, it's not to suggest that rising rates is a good environment for equities. It's not. Now, equities don't have to fall. We don't think they will. But it is going to be a struggle, and it is really trying to find the best parts of a market that's going to be more challenged.
Well, Daniel, rates aren't rising everywhere. Yes, you have the Fed, the BOE, maybe the ECB making moves in that direction this year. But in Asia, the BOJ, the PBOC, they are moving in the opposite direction or not moving at all. What kind of opportunity does that create?
Well, I think that sets up well. You were previously discussing about the discount of European stocks to the U.S., which may be an opportunity. We're looking, instead of maybe playing that particular trade where, again, in both markets, rates essentially are going to be rising, I'm thinking that you're going to find better opportunity in markets where, number one, you do have good earnings growth. And even though we don't think about Japan as a strong earnings growth market, at least for this year, it is quite good. China also rebounding from what had been a quite disappointing year last year. So you have the earnings growth, like you have in the U.S. But as you suggest, the key difference is a completely different monetary policy environment, probably steady or very modestly higher rates in Japan, probably lower rates in the future in China. And that's a huge contrast to certainly what's coming in the U.S. and what we think is going to be coming as well in the Eurozone.
All right, so we've talked about different regions and different sectors within equities where you want to put your money. What about different asset classes' performances to one another? Will stocks continue to outperform bonds, or do you anticipate we'll get a point where bonds actually become attractive because yields are so high?
Well, I think it was, again, kind of unusual. What we saw at the beginning of the year was the underperformance of equities versus bonds. But broadly speaking, in rising rate environment with the Fed hiking, equities do outperform. So lower returns in absolute lower returns in absolute figures for equities compared to your long-run average, but still better than bonds. So broadly speaking, we would expect that pattern to continue. So still equities better than bonds. Again, these sectors that are more positively sensitive to inflation, like commodities and potentially small caps, in addition to other assets. You want to think about, of course, inflation-linked bonds for protection over the longer term. So it is a question of trying to find those parts of the portfolio that are going to be the most resistant.
Daniel, thanks so much. Daniel Morris of BNP Paribas Asset Management. Whilst we were just talking about the markets there with Daniel, some lines dropping from Gazprom, the Russian supplier, of course. It says it is notifying clients of new payment rules Friday, assume that means today. Payments for exported gas are to be in line with Russian law, according to Gazprom, but they do go on to say that they responsibly continue to export gas to clients. Not much reaction in the European benchmark gas price right now. Why not? We'll talk to Biraj Borkhataria, who joins us shortly, RBC, co-head of European Energy Research. Great guest, great perspective to bring you at this point. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, U.S. Secretary of Labor Marty Walsh. That's at 9:30 a.m. in New York, 2:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, natural gas prices in Europe have been fluctuating over recent days as traders assess Russia's decision to shift payment for its gas supplies to rubles. Joining us now to help us understand all of the complexities here, Biraj Borkhataria, who's RBC Head of European Energy Research. Biraj, really nice to have you with us. So help us understand a little bit about this. So Gazprom says that this is all under, these are Russian contracts, I think they were talking about, with gas exported under Russian law. Can you help us understand what jurisdiction these contracts are under, what currency is mentioned there, and how much that matters? You know, at the end of the day, will it be contract law that decides this, or military might?
Yeah, it's actually very confusing because the message you're getting from both Putin, Draghi, and other German ministers is conflicting. So the contracts as they stand today denote a specific currency, which is euros, and amendments to those contracts would require agreement on both parties. So it's not entirely clear whether you could pay in euros to Gazprom Bank, and then the conversions and the currency switching could be done there. But at this point, the headlines seem to be fast and furious, and it's difficult to know where we stand.
I wonder if military might is even necessary for Russia to moot jurisdiction. We heard from the CEO of BASF today saying that the German economy would collapse, that it would be catastrophic and the worst recession since the Second World War for the country if gas was cut off. Do Europeans have any choice but to agree to Russian gas demands?
In a scenario where the flow of gas is cut off for contractual or other reasons, at that point, it's very significant, right? It's 30 to 40% of European gas needs. The governments and the regulators would have to step in and ultimately ration that gas and decide which industries are critical, which sources of demand are less critical, and ultimately do their best to try and protect the residential consumer as well.
Biraj, we're just getting some headlines out of the Kremlin. Spokesman Dmitry Peskov is speaking on a conference call. He says that gas will continue to flow while ruble payments are pending, and that ruble payments for April gas is due in late April and early May. So we continue to get the incremental updates on this from the Kremlin. Can we talk about where there's capacity elsewhere? Should anything go awry? Should supply get cut off? Of course, this is all hypothetical. Is there excess capacity in other places to come from? The U.S., for example, making that pledge on LNG. How far can that realistically go?
So it's important to highlight that the gas market was already extremely tight heading into all of this. And so if you could produce, you were making very significant profit margins. So Qatar was already exporting ahead of capacity. The U.S. was already growing. The incremental 15 BCM of U.S. exported to Europe, we calculate around 20 BCM of additional capacity into 2022. And most of that is already coming to Europe anyway. So with LNG, the price determines where the gas goes, whether it's Europe or Asia or South America. and not necessarily a letter from the White House. So we think that headline from the White House is basically non-news. The gas is already flowing to Europe because TTF is trading at a premium to JKM.
Is there the possibility of turning on alternative sources, Biraj? I mean, the Germans infamously have millions of tons of lignite coal, and also they've turned off all of their nuclear reactors, or most of them. So is it possible to get those things back up and running, or would it just take too long or be politically impossible?
So on the nuclear front, our understanding is those 3 nuclear reactors will be shut down at the end of this year. You are likely to see companies running coal assets harder, as hard as they can. You'll need a variety of measures in order to stave off Russian gas, but I can't understate how significant it is when it's 30% of your gas needs. You can't replace that overnight by LNG or otherwise.
You can't replace it, but you might need to step in to manage people's use of it, might you, Biraj? Are we heading in that direction in Germany or elsewhere? We saw the Germans enacting the first of a 3-part plan to, in the first stages, just monitor gas usage across the country in a kind of intensive way, but the suggestion being that later on there could be further involvement to try and make sure that stocks last as best as they possibly can. Are we looking at some kind of rationing as we go into the winter?
So it really depends on the flow of storage through the summer. So we expect summer pricing for European gas to be extremely strong because you need to incentivize more gas to go into storage. I think there'll be 2 prongs of how you ration gas. The first one is purely economics. So if you're a consumer in the UK, for example, as of today, your electricity and gas bill has gone up 50%. That might cause you to think about your usage, and that could see some demand destruction there. You'll have the same thought process from an industry standpoint. You might see refineries and chemicals facilities and so on maybe run at low utilizations because of the power prices just so high, which is obviously driven off gas. And then in a worst case scenario, yes, you'll have the regulators and the government have to step in and ultimately ration the gas if there's not enough to go around.
Yeah, how long before we get European leaders asking Europeans, and I mean that in the broadest sense, to consume less energy as a sort of patriotic act at a time where parts of Europe are at war? Biraj, thank you very much for your thoughts. Good to speak to you. Biraj Bokataria, RBC Head of European Energy Research. Coming up on this programme, we'll get the US perspective on energy and with Senior Advisor for Energy Security at the US State Department, Amos Hochstein. That conversation at 8 a.m. in New York, 1 p.m. in London, so a little bit later today. This is Bloomberg.